Wall Street, always going to look for ways to take advantage of you. There's a lot of new people out there getting to the market, millennials. Talked about it. Let's dig even further in this educational segment. I have a couple more examples I'm going to share with you of how Wall Street is looking to you know what. So let's take a look at Hertz. Okay, Hertz is a pretty big story now. I've been reporting on it ever since they announced the stock went to 5 and then eventually went to 6, that they're going to do an equity offering. The funny thing is Hertz filed for Chapter 11 bankruptcy. So that gives them a chance to reorganize. They have to pay their creditors. And then any money left over goes to the common shareholders, which is going to be nothing, right? Because they have $19 billion in debt, $1 billion in cash, and they don't have enough assets in their fleet to cover the $19 billion in debt. So huge speculation. You had millennials buying some of these things. It's not the reason why they went up. They went up because of algos, because they see all the millennials buying and they're pushing it. And they know when they push it to a certain level, there's a ton of people short, and they're going to be forced to cover, which push it to 3, 4, 5, 6, right? These are the algos. Again, they're front running everything. So what did Hertz do? They said, hey, you know what? We're going to announce a secondary offering. It's an equity offering to raise cash. So that's selling common shares. Most of the time, they'll do a discount to the current price. The company raises money, and Hertz was looking to raise $1 billion at the time. Now, here's where things get interesting. Hertz knows the common stock is worthless. They know. So they're trying to sell you something that's complete garbage. Because, yeah, when it comes to bankruptcy, Chapter 11, it's going to allow you to pay off your creditors and reorganize. The credit holders are going to get paid first. And whatever's left over goes to common stockholders. Again, $19 billion in debt, $1 billion in cash. Maybe they raise another $1 billion, still not going to make a big deal. But the common shareholders are going to get nothing. Now, if you think me saying the word worthless, or say, hey, Frank, you know what? You're full of shit. You don't know what you're talking about. The company's actually telling you that their stock is worthless. I read through their filing with the SEC that just filed for this to raise capital, which they need to do. And they say, specifically, I got to quote them, we're in the process of Chapter 11 reorganization, which may cause our common stock to decrease in value or may render our common stock worthless. Any trading on our common stock during the pendency of our Chapter 11 cases is highly speculative and poses substantial risks to purchasers of our common stock. And it says recoveries in Chapter 11 cases for holders of the common stock, if any, will depend upon our ability to negotiate and confirm a plan. They don't have a plan in place with their creditors yet. They don't have a plan in place. But if they do and they're able to raise $1 billion, that money's going to go directly to the creditors. Even if they have enough money to pay the creditors, they're going to keep it anyway and not give anything to common shareholders. They're going to reorganize, come out maybe with a different symbol, who knows? But this is all in their filing. And they say, although we cannot predict how our common stock will be treated under a plan, we expect that common stockholders will not receive a recovery through any plan unless the holders of more senior claims and interests, such as secured and unsecured debt, which is trading at a significant discount, which is bad, are paid in full. So they actually say significant risk that holders of our common stock will receive no recovery under the Chapter 11 cases, and that our common stock will be worthless. I'm quoting from the company. They're telling you it's worthless. And again, they don't have a plan in place or anything. Now, this is coming from Hertz, the company. Hertz, the company. That's just a small piece of this. This is what's really great. This is why everyone hates Wall Street, because what's worse is Jefferies, who's a very respectable investment bank, they're the ones underwriting this deal or acting as a sales agent. They're getting this stock at a penny, and they're going to sell it to their clients and anyone else who wants to own it. If it's 50 cents, 75 cents, 25 cents, the stock is now $1.80. Went down from 6 to 180. They're going to make money no matter what. And it's a massive win for the company. In fact, they can't lose because every share they sell, they own at a penny. They can sell for more than that. So Jeffrey knows the Hertz common is worthless, right? That's why they're buying it for a penny, and they're going to sell it to their clients, even though they know that it's worthless. At whatever, 50 cents, 75 cents, because they're going to make a massive spread on it. That's an investment bank selling this to their clients. Even better, right? Gets better. So that's Hertz, Jeffrey's investment bank. Even better is the SEC, who approved this deal. Because in this wonderful industry of Wall Street that I work in, you can basically do anything you want, as long as you disclose it. So a company could say, hey, Frank, I want you to pitch my company to all of your clients. Again, we'd never accept a dollar. We're independent ever. No one has ever paid for anything of the research. The only benefit is it goes up, you're going to pay for more subscriptions for my newsletter. That's how I do business. We don't do that. But say if I did, I could disclose that, hey, I'm getting paid for my research an amount of $100,000 and another $100,000 in stock at 10 cents. Even though the stock's trading at $2 a share, I can sell the stock immediately, even before you actually read this report. As long as I have that, I'm talking about my disclosure if I would do this. Then, of course, I'd say all of my research, though, while coming from reliable sources, should not be relied upon. And every investor should do their own homework before investing in any security. Translation, I'm going to you-know-what, write up your you-know-what. And I won't curse there. I'm basically dumping all of my shares to all the idiots who are going to buy this stock based on my BS promotion. When you lose all your money, and I'm at my beach house, about to go sailing on my yacht, don't call me because I don't care. There's nothing you can do about it because I disclosed that I was going to freaking rob you. I disclosed it. It's pretty amazing, our industry, right? So read those disclaimers at all times because they do say, and what they do, even the short sells. When you're looking at the short sells, it's an amazing market. I have no idea how this is legal. So what they do is they pile up positions, short the hell of a stock, right? And they come out with a report saying it's going to zero. Even if they think it's going down 20%, they're going to say it's going down to zero. They're going to take something in the risks in a prospectus that says, one of the biggest risks and cite it like, whatever it is. We could lose money in this. We could do that, right? And they're going to just publish that and say, and try to find something bad about the management team, publish this whole entire bogus report, and they're short. So then they're going to call a lot of services, places that you read. We've seen this happen with Seek and Alpha. We've seen it happen in lots of sites out there. And they have connections because they've given all these people shares and stock. Saying, hey, we're shorting this. You're in. Just once we go live with this, publish it. Now they come out with a report. It publishes at the same time on all these sites. And they have it in with all these ambulance-chasing lawyers, which you're going to see launch an investigation. They're not suing them. They're just launching an investigation. And that's why you see on some stocks, you'll see 20 different investigations. And what they do is they combine whoever gets the most, and they'll all combine and say, okay, let's share this. We'll have one big investigation. And most of the time they'll settle or whatever, but it doesn't even matter if it's real or not. If you read disclaimer, they're telling you that, hey, we're short. We could be out of this position by the time you read this, but they're going to crash the stock. And as they're crashing the stock, they're covering their position. And you need liquidity to do that. So when they send this out to everybody, then the lawyers get involved. And it's great. You ever see some of these companies that fall 20, 30%, you'll see like 5, 10 different cases from different lawyers. It's all premeditated. It's all set. So these guys are making a fortune telling you the stock's going to zero, even though they know it's not. They don't even care if it does, but they're able to push, especially small cap names, down 20, 30%. I've seen it numerous times. And companies are forced to defend themselves and say, this isn't true. Nobody really cares. But in the meantime, that whole process lasts for months. The stock gets killed. These guys are getting out the whole entire time. The whole scheme. Nobody cares. I would think that's fraudulent and illegal, but it's not. This is Wall Street for you. So if you look at Hertz and what they're doing, raising money through an equity offering while already filing for bankruptcy, let's talk about how rare this is, because I pulled a couple of quotes from really, really smart people in this field. This is Jared Ilias, a law professor at the University of California. He told the Wall Street Journal he studied hundreds of bankruptcies, never before seen a company trying to fund a case with an equity offering. That was in bankruptcy. Melanie Saganowski, former bankruptcy judge for the Eastern District of New York. She can't recall a company such as hers attempting to take such actions during 14 years on the bench, right? Such actions where you file for Chapter 11, basically the common's going to be worthless, but you're selling the common to investors. Stephen Schwartz, professor of law and business at Duke University, said never heard of a company attempting to sell shares like this unless it's part of a plan of reorganization under bankruptcy. They don't have a plan in place yet. They don't have the creditors or anything. They haven't announced a plan. They have no plan in place. They're going to take this money for themselves and split it up and say, hey, this goes to the creditors and go to us, whatever it is. But Wall Street is going to try to sell you this deal because apparently there are people who don't know better who are going to buy it because they don't understand how finance works, how the system works, where, hey, I'm buying a brand name, probably not going to go out of business. You may be right. The airlines, most of them went bankrupt and came out of bankruptcy. Okay, the common shareholders got crushed. But Hertz must pay off its creditors first, which they don't have enough money to do. They're not going to pay off the common shareholders because they don't have to. They don't have to. They're saying, well, if there's money left over, you get paid. They really don't have to. They'll find a way to say, well, there wasn't enough money left over. They'd rather keep that money to restructure, maybe coming out of bankruptcy, which will likely include a name change. That's how it works. Well, another example, look at WeWork, right? Property leasing company. Tech startup, one of the biggest ever. Limited its potential. It's going to transform how people work and live. WeWork was valued at $47 billion. This is like a month or two before its September IPO. $47 billion. And then as it came closer to the September IPO, right? Because they had a file, prospectus, all this stuff. You had some pretty smart investors trying to take a closer look at the fundamentals, which happened to change drastically over a 1 month period. Again, just for the IPO. For example, how many new workstations did WeWork deliver in the first half of this year? The prospectus filed in August said 273,000. A month later, an amended version said, whoa, it's only 106,000. What happened? Yes, what was the total gross of these workstations? Well, in August, WeWork said it was 1.3 billion. In September, it said, well, no, wait, it's 800 million. Think about that. You're changing your financials, which means it's not 800 million, right? You're not changing them higher, revising them higher, but right before. Those are massive red flags, massive red flags. Not to mention the prospectus mentioned nothing about the company purchasing a Gulfstream G650E, a top-of-the-line private jet, which it paid more than $60 million for. They didn't even disclose that. I mean, how does that conversation go? Wait, don't you guys have a jet? Oh, yeah, we do have a jet. We paid $60 million for it. Yeah, I forgot to put in prospectus. I'm sorry. Oh, okay. Well, let's just throw it in there. Okay. They didn't even have that in August or September before this kind of come out IPO. $60 million jet for personal use. So what they realized is WeWork was in a lot of trouble. They needed this IPO to happen because it was going to raise $9 billion for the company. And without it, these guys were in a lot of trouble. But it's not just WeWork. I mean, the Wall Street firms that are trying to fuck you. And I'm sorry, I'm cursing on purpose. I used to have a priest that listened to my podcast also make me say, he used to get mad at me, make me say Hail Fathers and Hail Marys and stuff. I'm using a curse word on purpose. This way I ingrain this in your head. Because you're looking at SoftBank, huge, helped inflate WeWork's valuation is $47 billion. JP Morgan was involved, other bankers from JP Morgan, the outside board of directors. These are guys with decades of experience in business and finance. And you should have seen by looking at this, just the potential conflicts of interest and the partnerships working in and out. It was amazing how many different classes of shares. It was nuts, giving them more voting rights. And it was so complicated, you couldn't really understand it. DAG Ventures, another Silicon Valley venture capital shop, invested WeWork at $440 million valuation. JP Morgan, their asset management arm. So not just research, but now their asset management. The research is pitching this thing that's the greatest thing ever to his clients. And their asset management arm is in at a $1.5 billion valuation. T. Rowe Price, another one, jumped in at the $5 billion valuation in 2014. Fidelity, Benchmark Capital. Then you have the founder, Adam Neumann. Again, so many partnerships, they couldn't even figure out how many shares he owned. Not to mention that he was selling a lot of his stock early on. You usually don't do that in the capital raise rounds. Maybe a little bit, but your interest should be aligned with everybody else. And he was selling in each capital round, go with $40 million of stock here in 2015, another $80 million a couple of years later. WeWork today, again, that $47 billion valuation, right? That Wall Street was dying to sell to you, that almost got that out to you, that people would have bought, especially millennials, because they're familiar with that company. Right now, it's valued at less than $3 billion. Again, this is a deal that came close to selling in September. If you look at the Ubers, the Lyfts, same thing. I mean, October 2008 valuation for Lyft was $15 billion, right? For October 2018. 6 months later, they came out in March, the IPO. It was valued at $24 billion. What changed in 6 months from $15 billion to $24 billion? That's a massive change in 6 months. What happened? Well, they did a roadshow. If you're looking at the fundamentals, really did make sense to me. I posted this on Twitter. One thing which I thought was amazing, they had a consulting firm who was invested in Lyft. They basically lied. They lied about Lyft's market share, which they said, hey, it was 39% market share, and Uber basically controls almost the rest, like 1 or 2% difference, right? Because those are two main players in the ride-hailing market. As of April 2020, that market share is 29%. But these are guys that provide this data. When you had an independent person, it was much, much lower market share. But if you look at the financials and everything, it was almost inflated, propping it up right ahead of the IPO, where mom and pop investors could buy, and they got wrecked on it. And remember, if you're buying in an IPO, on the day IPO, some of them work out great. That's fine. But that means someone is selling if you're buying. And who do you think is selling those shares? It's the management team who own the stock for pennies on the dollar and founder shares. IPO is a liquidation event. It gives those people, everybody who invests in the company, finally that liquidity period to sell their stock. Peter Thiel, the Facebook IPO. I mean, he sold. I don't think he even has a position in it anymore. Unfortunate for him. I think he came in at probably a $500 million valuation, and where to go public, whatever, billion, 30 billion, 40, whatever it was. And we know it's like 500 billion plus now. I mean, going through the roof, I think it's more like 700. I don't even know the market cap of some of these stocks anymore. But hey, he invested early, he gets out of the stock. I mean, you don't know if Facebook figured it out. And yeah, of course, they track all the data and everything like that, and the stock's gone through the roof. They're making money now. But these are liquidation events. This is where the insiders get to sell. And it's selling at an extreme high price to you, which is why IPOs come out at extreme valuations. And they better be growing. So they prop with financials and show tremendous growth heading in, to the point where Lyft should have came out at a $15 billion market share. Instead, it came out around $24 billion, which is crazy. This is how Wall Street works. Why am I spending so much time on this? Maybe you're like, big deal. I'm not in. Be interested. Because this is what you're up against if you want to learn. Don't trust anybody. Don't trust me. Read everything that I say. Make sure I do the research. If you look at my newsletters now, we're doing video newsletters where I share my screen and explain to you exactly the reasons why. It's going to be different reasons all the time that I'm buying stocks. You know I'm doing the research behind it. Make sure you know the person that you have a newsletter to is actually writing it, that he's involved in these stocks, that he's updating you all the time, that he's there for you when things are bad. I was doing daily videos during the coronavirus, during the heart of it, when the market was coming down, saying, hey, this is what we think. We're able to really predict that this market was going to come down pretty hard. Helped a lot of people out. Didn't think it'd come back so fast, but we still benefited. Went long lots of positions in the newsletters. But always, don't listen to some guy on TV. Most of them have an agenda. We just saw Bill Ackman cry his eyes out about his dad in Hilton Hotels when he had a massive position, telling the Fed, you have to bail out everybody, crying his eyes out. Again, all BS. That's what you're dealing with. Billionaires with high frequency systems and a lot of shady people, because Wall Street, not everyone's shady, but it's one of the easiest industries to get away with shit. Because even when you get fined, and you look at Merrill Lynch's and getting fined, Henry Blodgett. Hey, we fired Henry Blodgett. He's gone. He made freaking $25 million. We fined him $1 million. With those, I think it was one of the biggest settlements, which they made. I forgot how much it settled. It was probably about 1/10 of the amount of money they made. On all the research reports, basically telling you Amazon's going wherever back then. For all this crap crashed and evaluations and stuff like that. And Amazon actually turned out to be pretty good 20 years later, but for Wall Street, it's worth it. It's worth it. It's worth it to take on risk because you're going to get bailed out, especially in today's market. But be careful, especially new investors, mom and pop investors. Always do your own homework. Always ask as many questions as possible, because in our industry, all you have to do is disclose it. And if you don't read the disclosure, you don't even know what's happening. You could be buying something that sounds exciting through a promotion that someone's getting paid to write. and that they got shares for, and they're dumping it. So they need people to start buying it. And that's why they send it out to the masses. Just do your homework and do your research. It's one of the things I love to focus on with these podcasts and in my newsletters, where it's not just recommending stocks, it's teaching you. It's the education behind it. Because you got some very big, wealthy players against you, and they want to take everything you have. So the smarter you are, the more prepared you are, the more difficult it is for them to do that. So be very, very careful. Again, up against these big gorillas, but that's why I'm here to help you. I've been through Wall Street. I worked on Wall Street. I know all the main players. There's a lot of shadiness out there, guys. And hopefully we're able to protect you from it, because you want to be in this game long term. It's not just about generating huge profits right away or day trading and things like that. Again, this is for your future. This is to build your future. This is try to retire early. This is try to make sure that your kids might not have to work, even though you want them to work and have an education, all that. This is why we do this. Look at the bigger picture. Don't look at the smaller picture. Look at the bigger picture, and I'll make you a better investor.